more about derivatives. Derivatives are contracts between two parties that specify conditions under which payments have to be made between the parties. The conditions includes the dates, resulting values, and definitions of the underlying variables, the parties' contractual obligations, and the notional amount. The most common underlying assets include commodities, stocks, bonds, interest rates, and currencies. But they can also be other derivatives, which adds another layer of complexity to proper valuation. The components of a firm's capital structure, that is bonds and stock, can also be considered derivatives, more precisely options, with the underlying being the firm's assets, but this is unusual outside of technical contexts. From the economic point of view, financial derivatives are cash flows that are conditionally, stochastically, and discounted to present values. The market risk inherent in the underlying asset is attached to the financial derivative through contractual agreements and can be traded separately. The underlying asset does not have to be acquired. Derivatives allow, therefore, the breakup of ownership and participation in the market value of an asset. This also provides a considerable amount of freedom regarding the contract design. That contractual freedom allows to modify the participation in the performance of the underlying asset almost arbitrarily. Thus, the participation in the market value of the underlying can be effectively weaker, stronger, or implemented as inverse. Hence, specifically, the market price risk of the underlying asset can be controlled in almost every situation. There are two groups of derivative contracts. The privately traded OTC derivatives, such as swaps, that do not go through an exchange or intermediary, and ETTs, that is exchange traded derivatives, that are traded through specialized derivative exchanges or other exchanges. Derivatives are more common in the modern era, but their origins date back several centuries. One of the oldest derivatives is rice futures, which have been traded on the Dojima Rice Exchange since the 18th centuries. Derivatives are broadly categorized by the relationship between the underlying asset and derivative, the type of underlying asset, the market in which they trade, and their payoff profile. Derivatives may broadly be categorized as quote-unquote lock or quote-unquote option products. Lock products include swaps, futures, or forwards, and they obligate the contractual parties to the terms over the life of the contract. Option products, such as interest rate caps, provide the buyer the right, but not the obligation, to enter the contract under the terms specified. Derivatives can be used either for risk management or for speculation. This distinction is important because the former is a prudent aspect of operations and financial management for many firms across many industries. The latter offers managers and investors a risky opportunity to increase profit, which may or may not be properly disclosed to stakeholders. Along with many other financial products and services, derivative reforms is an element of Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. The Act delegated many rulemaking and details of regulatory oversight to the Commodity Futures Trading Commission (CFTC), and those details are not finalized or implemented as of 2012. Size of the derivative market. To give an idea of the size of derivative market, The Economist has reported that as of June 2011, the OTC size of the derivative market. To give an idea of size of the derivative market, The Economist has reported that as of June 2011, the OTC derivatives market amounted to approximately $700 trillion, and the size of the market traded on exchanges totaled an additional $83 trillion. However, these are just notional values, and some economists say that this value greatly exaggerates the market value and the true credit risk faced by the parties involved. For example, in 2010, while the aggregate of OTC derivatives exceeded $600 trillion, the value of the market was estimated much lower at $21 trillion. The credit risk equivalent of derivatives of contracts was estimated at $3.3 trillion only. Still, even these scaled down figures represent huge amounts of money. For perspective, the budget of total expenditure of US government during 2012 was $3.5 trillion and the total current value of US stock market is an estimated $23 trillion only. The world annual GDP is about $65 trillion. And for one specific type of derivative, that is CDS, for which the inherent risk is considered high, the higher nominal value remains relevant. It was this type of derivative that the investment magnate Warren Buffett referred to in his famous 2002 speech as weapons of financial mass destruction. CDS notional value in early 2012 amounted to $25.5 trillion, down from $55 trillion in 2008 that was almost equal to the GDP of the entire world. Usage of derivatives. 1. Hedge or mitigate risk in the underlying by entering into a derivative contract whose values moves in the opposite direction to their underlying position and cancels a part or all of it. 2. Create option ability, where the value of the derivative is linked to a specific condition or event. That is, for example, the underlying reaching a specific price level. 3. Obtain exposure to the underlying where it's not possible to trade in the underlying, for example, weather derivatives. 4. Provide leverage or gearing such that a small movement in the underlying value can cause a large difference in the value of the derivative. 5th. Speculate and make a profit if the value of the underlying asset moves the way they expect. 6th. Switch asset allocations between different asset classes without disturbing the underlying assets as part of transition management. 7th and more important, avoid paying taxes. For example, an equity swap allows an investor to receive steady payments based on LIBOR rate while avoiding paying capital gains tax and keeping the stock also. Mechanics and valuation basics. Lock products are theoretically valued at zero at the time of execution and thus do not typically require an upfront exchange between the parties. Based upon movements in the underlying asset over time, however, the value of the contract will fluctuate and the derivative may be either an asset that is in the money or a liability that is out of the money at different points throughout its life. Importantly, either party is therefore exposed to the credit quality of its counterparty and it's interested in protecting itself in an event of default. On the other hand, option products have immediate value at the outset because they provide specific protection, intrinsic value that is, over a given time period, that is time value. One common form of option product familiar to many consumers is insurance for homes and automobiles. The insured would pay more for a policy with greater liability protections, that is intrinsic value. The insured would pay more for a policy with greater liability protections and one that extends for a year rather than 6 months because of the immediate option value. The option purchaser typically pays an upfront premium just like for the lock products. Movements in the underlying asset will cause the option's intrinsic value to change over time while its time value deteriorates steadily until the contract expires, babe. An important difference between a lock product is that after the initial exchange, the option purchaser has no further liability to its counterparty. Upon maturity, the purchaser will execute the option if it has a positive value in the money or expire at no cost other than the initial premium that is out of the money. Hedging through derivatives. Derivatives allow risk related to the price of the underlying asset to be transferred from one party to another party. For example, a wheat farmer and a miller could sign a futures contract to exchange a specified amount of cash for a specified amount of wheat in the future. Both parties have reduced future risk. For the wheat farmer, the uncertainty of the price, and for the miller, the availability of wheat. However, there is still the risk that No weed will be available because of events unspecified by the contract. Yeah, such as whether or that one party will renege on the contract. Although a third party called a clearinghouse insures a futures contract, not all derivatives are insured, wave. From another perspective, the farmer and the miller both reduce a risk and acquire a risk when they sign the futures contract. The farmer reduces the risk that the price of the wheat will fall below the price specified in the contract and acquires the risk that the price of the wheat will rise above the price specified in the contract, thereby losing additional income that he could have earned. The miller, on the other hand, acquires the risk that the price of the wheat will fall below the price specified and reduces the risk that price will rise. In a sense, one party is the insurer for one type of risk and counterparty is insurer for other type of risk. See the cooperation? Hedging also occurs when an individual or institution buys an asset, such as a commodity, a bond that has coupon payments, a stock that pays dividends, and so on. Ignore the toy. And sells it using a futures contract. The individual or institution has access to the asset for a specified amount of time and can then sell it in the future at a specified price according to the futures contract. Of course, this allows the individual or institution the benefit of holding the asset while reducing the risk that the future selling price will deviate unexpectedly from the market's current assessment of the future value of the asset. Derivatives trading of this kind may serve the financial interest of certain particular businesses. For example, a corporation borrows a large sum of money at a specific interest rate. The interest rate on the loan reprices every 6 months. The corporation is concerned that the rate of the interest may be much higher in 6 months. The corporation could pay a forward rate agreement, that is FRA, which is a contract to pay a fixed rate of interest 6 months after purchases on a notional amount of money. If the interest rate after 6 months is above the contract rate, the seller will pay the difference to the corporation or the FRA buyer. If the rate is lower, however, the corporation will pay the difference to the seller. The purchase of FRA serves to reduce uncertainty concerning the rate increase and stabilize earnings. Derivatives used in speculation and arbitrage. Derivatives can be used to acquire risk also rather than to hedge against risk. That is the opposite. Some individuals and institutions will enter into a derivative contract to speculate on the value of the underlying asset, betting that the party seeking insurance will be wrong about the future value of the underlying asset. Speculators look to buy an asset in the future at a low price according to a derivative contract when the future market price is high, or to sell an asset in future at a high price according to a derivative contract when the future market price is less. Individuals and institutions may also look for arbitrage opportunities, as when the current buying price of an asset falls below the price specified in a futures contract to sell the asset. Speculative trading in derivatives gained a great deal of notoriety in 1995 when Nick Leeson, a trader at Barings Bank, made poor and unauthorized investments in futures contracts. Through a combination of poor judgment, lack of oversight by the bank's management and regulators, and unforeseen events like Cove earthquake, Leeson incurred a 1.3 billion US dollar loss that bankrupted the centuries-old institution. Isn't it funny?